When it comes to deal analysis, most business buyers have it wrong. They're usually asking the wrong questions based on the wrong strategy. And a lot of them have it backwards. So in today's video, I want to demystify that, and I want to show you how to actually analyze a deal based on certain parameters, what it makes most sense based on the strategy. Then you can superimpose that strategy into analyzing the deal to see if it makes sense for you. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by buying a profitable business, or a W-2 executive or employee looking to get out of the race by buying a profitable business, you are in the right place. Please subscribe to my channel and don't forget to hit the bell, and you'll be notified every Thursday when new content comes out. All right, let's get into it. So when it comes to best analyzed deals, say you're looking for a business to buy, here are the 6 criteria that I want you to, this criteria is going to help you put the deal in perspective to see if it makes sense for you. Number 1, management strategy. It's either going to be active management or partial management or absentee management. Now, how you go about management is going to dictate other things. So for instance, depending on the size of the deal, you may require by the lender to be on site. In really large, robust deals where the cash flow is north of $500,000, the CEO will be expected to be on site. So, and it usually happens in the trades. If you have anything that requires a license, whether you have the license or not prior to buying a business, you will need to manage this business. So a lot of these trade businesses, HVAC, roofing, home restoration, paving, plastering, anything that has to do with construction around the home, plumbing, HVAC, etc., they require you detailed management and robust knowledge, and you need to be on site. So how you figure that out, that's how you're going to be able to look to the lenses of which you're going to be looking at the deal. So active management, first you need to determine how active are you going to be in the management of this business. The more active you are, you need to be on site. There's going to be plenty of cash flow you need to have to make sure that you have the salary to cover you, and you have enough post-debt service cash flow for capital expenditures. Depending on the industry you're getting into, you need to have a really strong cushion on your post-debt service cash flow in order to be able for you to do that. So that's why you probably be looking at deals that have at least 1.5 to 2 times debt service coverage ratio, cash flow over debt service. So think about it. Are you going to be leaving your current job and make this business a full-time thing? And if so, think carefully, right? What is your existing W-2 income, and how much will you need to pay yourself as an active manager to be able to do that? Right? All of that is also going to come up when you're talking to the lenders. First thing they're going to want to know is, hey, so are you going to be actually running this business? If so, how do you want to proceed? So now, for instance, if you're looking at a deal, there are certain plays that investors make that you can actually go with very partial or absentee management. You can actually have a GM. Usually businesses where there is some type of real estate involved, RV or park RV or park campgrounds, mobile home parks, self-storage. Those are technically businesses, even though there's real estate associated with it. You don't need to technically be there every day, but there's a different strategy, right? Investors that get involved in those are looking for maybe not as robust cash flow. Maybe you're not looking about $300,000 to $500,000 a year in cash flow. It's going to be lesser cash flow, but there's going to be lesser involvement. So you're trading more cash flow for for higher involvement, or lesser cash flow for lesser involvement. Perhaps you want an appreciation and depreciation play. Perhaps you already have enough income and you don't want to leave your current job because it's a job that you can do remote, you can do whatever you wanted to, and you have flexibility. You can come and go as you please. If that is the case, you may be better off with some type of semi-absentee type of businesses, so long as you can justify the path if you're trying to finance the deal with an SBA lender. So number 1. Number 2, what is your funding strategy? Is it going to be primarily a seller financing option, seller financing play, or is it going to be a bank financing play? If your funding strategy is, which is something that I teach heavily, is working with SBA lenders, SBA preferred lenders, then you're going to need to have strong business with strong financials. And by that I mean strong tax returns. So if you're talking to a seller, whether represented by a broker or not, and that seller has done the right thing and they have filed for income tax returns and they're showing plenty of income, which means that income that can be relied on, then, and they have that evidence in their tax returns, whether it is C Corp, S Corp, LLC, however, whether they're paying themselves a salary or not, is there enough cash flow coming from the tax returns to cover the debt service ratio on a loan, healthy, with a nice trend year over year, and they have every year filed, and you only have the interim that you work with, but you can satisfy the bank? I say go with the SBA lender. They're gonna give you, you're gonna turn you into a cash buyer. That's what I normally teach. But there are times that you're not gonna have those tax returns. There are some industries that are notorious for having their sellers kind of hide some of their income, perhaps doing a little tax evasion. They don't report all their income, or there is cash involved. So that's hard to quantify that, and it's hard to show up in the tax returns, or they don't simply haven't filed the tax returns for years. And you believe that this is a good deal. So how are you gonna get it to the finish line? How are you gonna get the deal financed? So your funding strategy, you need to know, you need to going in, you need to know how you're gonna approach this. And it's gonna help if you know what industry you're dealing with. I teach my group coaching program that you have to become a subject matter expert in whatever industries you want to get into. So if you know that the industry is notorious for not having tax returns on time, you know that your play is going to be seller financing. So when you're doing seller financing, there are ways to protect yourself on seller financing. You may have some clawback provisions, which means that if there are some formulas that are set in place in the asset purchase agreement, in which if the revenue or the seller discretionary earnings or whatever is defined falls between a certain threshold, then the seller is penalized by having a reduction on their loan principal if things don't come through. So that are ways to protect yourself and make the seller make sure they're more honest when they're helping you analyze the deal. They're selling their business to you and they believe in it. If a seller really believes strongly on the deal that they're selling, they'll be very prone to likely to do seller finance if they know they cannot justify the cash flow of the deal through their tax returns. So again, your funding strategy is going to dictate how you approach this deal. Next, number 3, distance. Are you going to be nearby or farther away? Now, if you're planning to buy a business where they're one city away or in another state away, it's different if you're looking at a business that is within driving distance within the hour. And you're going to be, then again, are you going to be actively involved or going to be more absentee or less involved? So if the farther away a business is, the more complex the maneuvering to manage the business. You have to have more technology in place. That needs to be factored in. A lot of lenders have a hard time making sense of buying a business long distance unless there is a solid strategy in place. You, as a buyer, it behooves you to have all those situations figured out before you start shopping for deals. If you know that you're looking, for whatever reason, if you're looking for a real estate play and you know that the capitalization rates or the cap rates, as we call them, are going to be high, do you need help in buying a business? Are you stuck and trying to figure out how to get things done, how to find the lender, how to pre-qualify the deal, how to actually look at the debt service coverage ratio, and many other things and questions that I'm sure you already have? Let's connect. I have a free complimentary strategy call for everybody who watches my videos. All you have to do is follow the prompts and connect with me via email. Email address is above, and it's always at the description section of this video. Let's connect and let me help you buy a profitable business. In different states, I'm in California. I know that if I want to do a real estate play, whether self-storage or mobile home parks, they're going to be very, very low cap rates. Very difficult to compete and very difficult to get those deals cash flow with an SBA loan. So if I'm looking to elsewhere, then I have to have a strategy in place to be able to satisfy the lender to their requirements. How am I going to get this business managed far away? So that factors into your strategy. And then you're going to be able to think of this strategies as lenses on the deal. So you got your management strategy. It's one way to look at it. Your funding strategy is another lens that you're going to put through the deal. The distance is certainly another one. Number 4, what is your pre and post debt service cash flow? So if you're looking at a business that has very, very thin post debt service cash flow, and you're doing a value add play and you're not going in that this is going to be a value add play, which means you're going to get it at a cheaper, you're going to get it for a less expensive than you would if it was totally optimized. Well, if that is your strategy, well, it's going to be very thin on the post debt service cash flow. So which means that you would have to have good industry knowledge and a way to kind of figure that out, which is something I'm going to talk about next, right? So a lot of these things are closely tied. Your pre and post debt service cash flow on the debt service coverage ratio dictate what your strategy is going to be for any place heavily into what's coming next, which is industry knowledge. How well do you know the industry that you want to buy into? If you know the industry very well, you're going to understand the nuances of how to operate that business. Things that to the untrained eye wouldn't make sense, they're going to pop at you. You're going to be able to make more sense of it, which actually lowers the risk profile of the deal overall, right? I always say that lenders only care about one thing, and I know there are a lot of lenders who watch my videos, is risk mitigation. The lower the risk profile on a deal, which means all the other variables make sense, the higher likelihood that that deal will be approved on your behalf. So how well do you know the industry you're going into? There are tools, there are software tools, there's ways, there are publications, there are trade publications. If you want to get into an industry, it behooves you to get that very, very deep and understand the rules of thumb for that particular industry. For instance, what is the average cost of goods sold if there's cost of goods sold involved? What is the average inventory? What is the average ARO turnover? How quickly it would turn over in your AR? What are the risks associated with the industry from a third-party perspective? All of those things help you analyze things. The more industry knowledge you have, the better it is. And the better you're going to be able to analyze the deal, which is what I was saying on the post-service cash flow, right? If this is all intimately tied together. If you want to buy, and it's just no different than when you're actually assessing real estate. When you're assessing real estate, you make money when you buy, not when you sell. Same with a business. If you have a business, so that's what I always say, if regardless of what the purchase price of the business, or however the listing agent has it, is irrelevant to us, because we're going to figure out based on these strategies that we're talking about, how to best position the deal so actually buy it right. And if you want to do a value add play, it means it's going to be a little thinner on the cash flow, which means it may be a little farther away, which means you're going to have more industry knowledge, which means you're going to have to do some seller finance with some clawback provisions, and you're going to have a management in place. Hence, your management strategy is going to be more of a remote with seller finance, leaner post-debt service cash flow, farther away, which means but you do have some industry knowledge. So just to recap, we have management strategy, funding strategy, distance to the deal, pre and post-debt service cash flow, industry knowledge. And last but not least, number 6 is going to be your revenue and SDE trending. Now, there is a tool within our deal analyzer, which is the deal analyzer tool that is within our community, within Business Acquisition Mastery. And if you want to know more about it, please, by all means, reach out to me. We have a very robust tool that allows us to actually it's like an underwriting tool that lenders use. We're going to take a lot of the data, some of the data points from the tax returns for the business, and we're going to put them into this tool. It was going to calculate, it's going to give us the numbers, they tie to the tax returns, but it's going to give us the percentages. And it's going to calculate the cash flow based on the accepted add backs. And you're going to start to see some trends. More important than the numbers themselves are the percentages as they tie to the income. How is your revenue trending year over year over the last 4 years as per the tax returns or whatever information you get? How is the seller discretionary earnings trending in the last 4 to 5 years? Is it going up? Is it going down? Is it staying flat? Why or why not? Is the revenue going up? Is it going down? Is it staying flat? Why or why not? Now, a lot of brokers will grossly overestimate the amount of add backs that a seller has to boost the cash flow so they can boost the purchase price or the sales price, whatever the listing price is. We are the buyer, so we're going to come up with our purchase price. We may be different than the listing price, but we're going to back ourselves into real data. So revenue and trending, Obviously, the nice thing would be, the ideal situation would be the trending is nice 10% year over year increase on an industry that is a very cottage industry that has a lot of room for growth, that has not been absorbed by the big players, that has not largely unconsolidated. All of those things play a factor. So revenue and SDE trending, what I always like to figure out is, how do we position ourselves when it comes to this valuation? How much money do we offer? And what cash flow do we use for our multiple? And what multiple trigger do we use, and from what software? All of those things I teach. But at the very basic level, if you take the last 3 years worth of tax returns and you average them, you're gonna have your average 3-year revenue and your average 3-year cash flow, or SDE. Now, what does that number tell you? Is it higher or lower than the cash flow as advertised by the seller or the listing agent? What does it tell you, right? I know for a fact that most brokers will actually come out to market with the most profitable year. So in that case, we're looking at 2023, right? If the 22, say a business that has been doing, on average 300,000 in seller discretionary earnings in 2020, 21, 22, and in 2023, they year $500,000 for whatever reason, we don't know. And then when they figure, okay, so they did $500,000, so this business is worth at least 3.5 times that. So they're gonna come up with a $1.7+ million calculation, right? Well, that's what they think the business is worth. We're gonna do our own analysis, and we're gonna see 300, 300, 300, and then 500,000. We wanna know what happened, right? Why did the revenue go up? And are we just gonna reward them for the upside on one-off year? Or are we gonna average it out? It really depends on many variables. It really depends on your appetite for the deal, your management strategy, the funding strategy, the distance. Let me give you one example. There are sometimes businesses that there's a lot of competition for the business, and that's another thing. How many people are competing in this business that you're trying to buy, right? If it is a cash flow, very successful cash flowing business, there's going to be a lot of competition. So you have to understand, if you nickel and dime the seller, you may be just outbidded. So things that you have to consider is, okay, so if you want to give the seller credit for that year, and you know that the potential is way beyond the 500,000, then beauty is in the eye of the beholder. What do you see when you're looking at the deal? And the more you know about the deal, the better. So this is how I teach and how I look at deals, and through the lenses of which I analyze deals. Then once you have all of that framing in mind and all those lenses that you put on the deal, then you're gonna be able to say, okay, well, I know that this industry NAICS code has a multiple of 2 to 3.5 times SDE and 3 to 4 times adjusted EBITDA, and that I know that I can actually be able to work in working capital because it's heavy on the CapEx side, etc. It just helps you frame the deal better. So hopefully I was able to help you guys out, and keep looking at deals. Please reach out to me if you need my help. For a limited time, I'm giving away my Deal Analyzer 2.0, which is the latest version of my free tool when it comes to analyzing deals. It has most of the things you're gonna need to analyze a deal, like your cash on cash return, your debt service coverage ratio, your post-debt service cash flow, your pre-debt service cash flow, and many other little things that you're gonna need in order to make sure that you have a good deal that is worth looking at. It is a free gift. All you have to do is click on the link below, and it's yours to have it. And I'm doing that because I wanna thank you for being part of my community on YouTube. Thank you.